A company that spent $2 million on a Super Bowl ad while burning through $300 million in investor cash filed for bankruptcy in just 268 days. This is the story of Pets.com, the sock puppet that became the poster child for everything wrong with the dot-com bubble. In January 2000, millions of Americans watched a talking dog mascot promise to revolutionize pet ownership during the most expensive advertising slot on television. 9 months later, the company was dead, its employees were unemployed, and investors had lost every penny. The sock puppet that once graced Times Square billboards and late-night talk shows became a symbol of Silicon Valley excess and the dangers of prioritizing marketing over mathematics. This wasn't just a business failure. It was a master class in how not to build a company, featuring every possible mistake an entrepreneur could make rolled into one spectacular disaster. The story begins in 1998, when two entrepreneurs decided that pet owners desperately needed a better way to buy dog food and cat litter. The founders believed they had identified a massive market opportunity in the $32 billion pet industry, which seemed ripe for digital disruption. Their vision was simple: create an online marketplace where pet owners could order supplies with the click of a mouse and have everything delivered to their doorstep. The timing seemed perfect, as internet adoption was accelerating and consumers were becoming more comfortable with online shopping. Amazon had proven that people would buy books online, so why not pet food? The entrepreneurs secured initial funding and launched their website in August 1998, positioning themselves as the definitive destination for pet supplies on the internet. They promised competitive prices, convenient delivery, and a selection that no physical pet store could match. The founders genuinely believed they were building the future of pet retail, and in the euphoric atmosphere of the late 90s, investors were eager to fund that future. Within months, Pets.com became the darling of Silicon Valley venture capitalists and Wall Street investment banks. The company raised $9.3 million in its first major funding round, followed by another $50 million in early 1999. By the time they went public in February 2000, they had raised over $150 million from investors who believed the internet would transform every retail category. The company's initial public offering priced shares at $11 each, valuing the 18-month-old company at nearly $300 million despite minimal revenue. The sock puppet mascot, created by the advertising agency TBWA Chiat became an instant cultural phenomenon, appearing on talk shows, magazine covers, and eventually a Macy's Thanksgiving Day parade float. The puppet's catchphrase, "Because pets can't drive," captured the company's value proposition in 6 memorable words that resonated with consumers and investors alike. Media coverage was overwhelmingly positive, with business magazines praising the company's innovative approach and bold marketing strategy. The founders were featured on magazine covers as visionary entrepreneurs who understood the future of commerce better than traditional retailers. The fundamental problem was that selling pet food online made absolutely no financial sense. Pet supplies are heavy, bulky, and cheap, the worst possible combination for an e-commerce business model built on shipping costs. A 20-pound bag of dog food might sell for $15 but cost $8 to ship, immediately erasing any profit margin. The company was essentially paying customers to shop with them, subsidizing shipping costs to maintain the illusion of competitive pricing. Industry veterans warned that pet supplies were a low-margin business even in physical stores, where customers carried their own purchases home. Pets.com was taking products with razor-thin margins and adding expensive fulfillment and shipping costs on top. The economics were so upside down that the company lost money on every single transaction, hoping to somehow achieve profitability through scale and efficiency improvements that would never materialize. Meanwhile, established pet retailers like Petco and PetSmart had decades of experience managing inventory, supplier relationships, and customer service, advantages that couldn't be replicated with venture capital funding and Silicon Valley enthusiasm. The company's business model required them to convince millions of Americans to change their pet shopping habits for a service that was actually more expensive and less convenient than visiting a local pet store. By late 1999, warning signs were everywhere for anyone willing to look past the marketing hype. The company was burning through $15 million per quarter while generating less than $10 million in annual revenue. Customer acquisition costs were astronomical, often exceeding $100 per customer in a business where average order values struggled to reach $50. The company's own internal metrics showed that most customers made only one or two purchases before abandoning the platform, making it impossible to recover marketing investments through repeat business. Inventory management became a nightmare as the company struggled to predict demand across thousands of products in dozens of categories. The website frequently showed items as available when they were actually out of stock, leading to customer service disasters and canceled orders. Fulfillment centers were plagued by inefficiencies, with employees reporting chaotic working conditions and outdated inventory systems. Industry analysts began questioning the company's path to profitability, but management continued to insist that scale would solve their problems. The company's quarterly earnings calls became exercises in creative accounting as executives highlighted growing website traffic and customer registrations while downplaying the mounting losses and cash burn rate. The turning point came in March 2000 when the Nasdaq began its steep decline, and investors suddenly became skeptical of companies that prioritized growth over profits. Pets.com's stock price, which had peaked at $14 per share shortly after the IPO, began a relentless slide as institutional investors dumped their positions. The company desperately needed additional funding to continue operations, but venture capitalists who had been eager to invest just months earlier were now demanding clear paths to profitability. Management attempted to pivot the business model, exploring partnerships with traditional retailers and reducing marketing spending, but these changes came too late to save the company. The dot-com crash had fundamentally altered the investment landscape, and companies like Pets.com that depended on continuous funding injections found themselves unable to raise capital. Amazon, which had been a major investor and partner, began distancing itself from the struggling pet retailer. The sock puppet mascot that had once been the company's greatest asset became a liability, as it symbolized the kind of frivolous spending that investors now viewed with suspicion. By summer 2000, it was clear that Pets.com was running out of both money and options. The collapse was swift and brutal. In November 2000, just 9 months after going public, Pets.com announced it was shutting down operations and liquidating its assets. The company had burned through nearly $300 million in investor funding while generating only $64 million in lifetime revenue. Over 300 employees lost their jobs with minimal severance packages, and many discovered that their stock options were worthless. The liquidation process was a fire sale, with inventory sold at pennies on the dollar, and warehouse equipment auctioned off to competitors. Shareholders received nothing, with the stock price falling from its IPO price of $11 to essentially zero in less than 10 months. The speed of the collapse shocked even seasoned Silicon Valley observers who had predicted the company's struggles, but not the dramatic finality of its demise. Lawsuits followed, as investors accused the company of misleading them about its financial prospects and business model viability. The sock puppet mascot, once valued at millions of dollars in brand equity, was sold to a competitor for a fraction of its perceived worth during the height of the company's popularity. The immediate aftermath sent shockwaves through Silicon Valley and Wall Street, serving as a wake-up call about the dangers of the dot-com bubble mentality. Pets.com became shorthand for startup excess and the folly of prioritizing marketing over sustainable business fundamentals. Venture capital firms that had invested in the company faced difficult conversations with their limited partners about due diligence failures and investment oversight. The collapse contributed to a broader crisis of confidence in internet stocks, accelerating the Nasdaq decline that wiped out trillions of dollars in market value. Business schools began using Pets.com as a case study in how not to build a company, analyzing every aspect of its failed strategy for future entrepreneurs to study. The sock puppet became a cultural touchstone, referenced in movies, television shows, and comedy routines as a symbol of Silicon Valley hubris. Employees who had worked at the company found that Pets.com on their resume was sometimes viewed as a liability rather than startup experience. The founders largely disappeared from the public eye, their brief moment as celebrated entrepreneurs replaced by infamy as the leaders of one of the most spectacular business failures in American history. The broader impact on the e-commerce industry was profound and long-lasting, fundamentally changing how investors and entrepreneurs approached online retail businesses. Companies across Silicon Valley were forced to demonstrate clear paths to profitability, rather than relying on growth metrics and market share projections. The collapse validated critics who had argued that many dot-com business models were fundamentally flawed, built on the assumption that the internet would magically solve the basic economics of retail. Subsequent e-commerce companies like Chewy, which eventually succeeded in online pet retail, learned from Pets.com's mistakes by focusing on higher-margin products, efficient logistics, and sustainable unit economics. The failure also highlighted the importance of understanding industry-specific challenges rather than assuming that successful internet models could be applied to any retail category. Investors became more sophisticated about evaluating e-commerce proposals, demanding detailed financial projections and realistic assessments of customer acquisition costs and lifetime value. The venture capital industry implemented more rigorous due diligence processes, particularly for retail-focused internet companies. Marketing strategy shifted away from expensive brand-building campaigns toward more measurable, performance-based advertising approaches that could demonstrate clear returns on investment. The lesson of Pets.com remains relevant today as entrepreneurs continue to build companies in an era of abundant venture capital and technological optimism. The story demonstrates that no amount of marketing sophistication or investor enthusiasm can overcome fundamentally broken business economics. Companies must solve real problems for customers in ways that create sustainable value, not just convenient solutions that require continuous subsidization. The failure illustrates the danger of confusing customer interest with customer willingness to pay, as millions of people enjoyed the sock puppet commercials without ever becoming profitable customers. Entrepreneurs today should remember that successful businesses require more than identifying large markets and raising substantial funding. They need viable paths to profitability that don't depend on perfect execution of optimistic projections. The Pets.com story serves as a permanent reminder that in business, as in life, mathematics eventually wins over marketing, and reality always trumps even the most compelling vision. $300 million and countless careers were sacrificed to teach Silicon Valley a lesson it should have already known. Businesses succeed by creating value for customers while generating profits for owners, not by convincing investors to fund losses indefinitely while hoping for miraculous transformations that never come.